As we check the monitors, Nuburu Inc., trading under the ticker BURO, is currently active on the NYSE American. The stock is seeing significant movement in today's session, trading within a volatile range between 0.2435 and 0.2804 per share. This is a stock defined by massive volume, with today's activity already reaching toward 56 million shares, confirming its status as a high-velocity trading vehicle. But the immediate insight that most traders are missing isn't just the price. It's the fact that this company is no longer just the blue laser specialist that it was when it came public. The entire narrative has shifted to a complex, high-stakes pivot into defense, software, and a desperate battle for exchange compliance. The story here is not about the technology everyone thought they were buying. It's about a complete corporate overhaul happening in real time under immense pressure. The general expectation for a stock like BURU, especially after its fall from post-SPAC highs, is one of two things. Either it's a pump and dump, as many frustrated commenters on financial forums are quick to point out, or it's a deeply undervalued technology play waiting for a squeeze. We see this sentiment reflected in online discussions, where one group is calling for the stock to reach $1 and lamenting the short sellers, while the other group points to a chart that has seen a near-total wipeout, claiming recovery is impossible. The reality, however, is far more complex and perhaps more precarious than either side fully appreciates. The true narrative is one of survival. Nuburu is currently engaged in a transformation plan, a strategy that involves acquiring new assets to fundamentally change its business model, precisely because the original blue laser business has been unable to support its valuation or operations. This brings us to the recent stock movement, which is not being driven by new laser contracts. It's being driven by SEC filings and news releases about this transformation. Just last week, on November 6th, the company announced it was advancing its defense tech acquisition program and attempting to revamp its blue laser business. This is directly tied to its agreement to acquire Orbit SRL, an Italian software firm. This isn't just a minor acquisition, it is a related party transaction. SEC filings from late October and early November clarify that Orbit is owned by Alessandro Zamboni, who is also Nuburu's executive chairman and co-chief executive officer. This is the kind of detail that forces a reevaluation. Is this a savvy strategic pivot into operational resilience and crisis management software, as the company states? Or is it a complex financial maneuver to inject assets into a struggling public entity? This related party component adds a significant layer of risk and scrutiny that the market is clearly struggling to price in, hence the wild volume and intraday volatility. Comment below if you think this acquisition of Orbit is a legitimate pivot or a related party bailout. This pivot is happening under duress. The company's very listing on the NYSE American is at stake. Nuburu has been in a prolonged fight with the exchange. Back in April, it received a notice of non-compliance because its stockholders' equity was in deficit, a violation of Section 1003A(1) of the Exchange Guide. This is a fundamental sign of deep financial distress. The exchange accepted a compliance plan, giving the company an extension until October 2026 to fix its balance sheet. But the trouble didn't stop. In mid-October, Nuburu received another warning letter from the exchange, this time for violating Section 401A because it failed to properly notify the exchange before issuing a material press release about implementing a new dual CEO structure. These are not the actions of a healthy, stable company. This is the behavior of a company in crisis, moving so fast to restructure that it's tripping over basic disclosure and governance rules. This compliance battle is the ticking clock in the background of every trade. If they fail to meet the plan, delisting is a very real possibility. Now let's talk about the short sellers, because they are a massive part of this story. The bears are not just passively watching, they are actively increasing their bets against the company. According to the most recent data, short interest in BURU has exploded. We are seeing figures as high as 20.44 million shares sold short, which represents a staggering 59.4% increase from the prior month's report. Depending on how the float is calculated, this short interest represents anywhere from 15.5 to over 26% of the shares available for trading. This is an extremely high level of bearish commitment. It signals that a significant portion of the market is betting that this transformation plan will fail and the stock will go lower. What's your take on the massive 59% jump in short interest? Are the bears right about the fundamentals, or is this an overplay? For investors looking for actionable insights from this data, the story tells a nuanced story. While the high short interest might make some hope for a short squeeze, other metrics suggest caution. The days-to-cover ratio is incredibly low, at just 0.2 to 0.4. Because the average trading volume is so astronomically high, often exceeding 100 million shares, the short sellers are not trapped. They could, in theory, cover their entire 20 million share position in a matter of hours, not days. This means a sustained squeeze is very difficult to orchestrate. Furthermore, the borrow fee rate, or the cost to borrow shares to short, is elevated but not extreme, hovering around 8%. This indicates that while there is demand to short the stock, it's not in a hard-to-borrow panic mode. Perhaps most revealing is the off-exchange short volume. Data from FINRA shows that on many recent days, the off-exchange short volume ratio has been well over 50%. Reaching nearly 58% on November 7th. This means a huge portion of the bearish trading is happening away from the public exchanges, often indicative of sophisticated or institutional players building their positions. To track this, investors should monitor sources like Fintel or MarketBeat, which aggregate official exchange and FINRA data. Look for spikes in the borrow rate or significant changes in the short volume ratio as signals for the next big move. So, what does Nuburu actually do? Or rather, what did it do? The company was founded on the premise of its industrial blue laser technology. These high-power lasers are supposedly more effective than traditional infrared lasers for welding and 3D printing, particularly with metals like copper, which are highly reflective. This technology was aimed at the electric vehicle market for battery manufacturing and other advanced industrial applications. This was the expectation, a pure play on a next-generation industrial tool. The reality, however, is that the company has been consistently unprofitable, with declining revenues. Recent financial check-ins show losses have actually increased over the past 5 years. Even more concerning, a filing from May 2025 noted the impact of a foreclosure that resulted in the loss of the company's patent portfolio. This is a critical blow to a company whose entire value proposition was based on its unique intellectual property. This context makes the current transformation plan make sense. The original business model appears to be non-viable, forcing the company to pivot to defense and software via acquisitions like the Orbit deal and a new joint venture with Maddox Defense for drone technologies. Looking forward, the future of Nuburu is a binary outcome. The expectation of the remaining bulls is that this pivot is genius. They see a company shedding its old cash-burning skin and acquiring new relevant assets in the hot defense and security sectors. If this plan works, if they successfully integrate Orbit, if the Maddox drone JV lands contracts, and if they can use these new assets to satisfy the NYSE's stockholders' equity requirements, the current stock price will look absurdly cheap. The few remaining bulls are betting on this complete 180-degree turnaround, believing the new management structure and assets will save the company and send the heavily shorted stock flying. The reality, however, is shadowed by significant risks. The bear case, which is heavily supported by that 59% jump in short interest, is that this is a